Now I'm going to talk about some investment strategies. And to do that, I'm going to stay on in the baseball analogy. And there was a movie last year, or this year, depending on if it's still running, based on a book by Michael Lewis called Moneyball. And the main idea in the book, in the movie, was collective wisdom for finding and drafting players was, for baseball players, you wanted to have players that were good at stealing bases, hit a lot of RBIs, had high batting average, and they were very interested in high school grads. Whereas the Oakland A's, they used a lot of quantitative research, and they found that those players typically were overvalued. And what really made a winning baseball team was on-base percentage, slugging percentage, and college grads. And we have a sort of similar way of looking at the conventional wisdom. Because in the investment market, the typical retail portfolio, as David went through, is basically based on stocks and bonds and capital gains. Whereas for us, we look for diversification and cash flow. Now, the other thing, in the movie, the general manager of the Oakland A's, who was Billy Beane, was played by Brad Pitt, whereas our GM, CEO, is John Nicola. So that only goes to show you can only take an analogy so far. Now, why we're bringing this up is because in that conventional portfolio, you have bonds and stocks. And we've already talked about stocks, and they've had a flat return for 10 years. We're concerned about bonds. It's that other cornerstone in that conventional portfolio. Because if you look at this graph, interest rates have been falling for 30 years. At some point, they're going to start increasing, and we think that could be relatively soon. Now, there's an example and a precedent for interest rates staying low for an extended period of time, and that is Japan. But we don't think the U.S. is Japan. We think, as we mentioned earlier, the deleveraging cycle is moving very nicely, very quickly. We think that interest rates, the economy is starting to pick up. There's only one reason why interest rates can stay where they are or move lower, and that is, like you have in Japan, deflation. There's two reasons why it can go up. One is if you have a stronger economy, which we think we're starting to see, or you could have inflation, which could come with higher oil prices, which we think we could see. And the second would be concerns over debt, which goes back to that previous threat we talked about. If the U.S. doesn't do something about their deficit situation, eventually people are not going to buy their bonds, and interest rates will have to go up. Now, I'll give you an example of in a portfolio of what this means is, right now in Canada, if you buy a 10-year bond, it's going to pay you 2% a year for 10 years. At the end of 10 years, you'll get your principal back, but you're only getting 10% a year. But keep in mind, headline inflation in Canada is running around 3%. So your real return is actually minus 1%. That means if you buy a 10-year bond today, you're locking in a minus 1% return. Alternatively, what I would do, what I think is a better deal, is I'd buy a common stock, a good dividend-paying common stock like Shaw. Now, I know you might have been on their call wait or been on hold trying to talk to a representative from Shaw for 4 hours like me, but this is a good company with rising cash flows. That 4.8% dividend yield is only going to increase over the years. And you also have a good chance of getting capital appreciation with that. So we think that makes more sense in this environment than buying a bond that's going to pay you 2%. There are other cash flow vehicles you can do that give you the same protection. The first one I'm going to mention is short-term bonds. Short-term bonds, they don't pay a lot in interest, but they give you liquidity and they give you capital preservation. And they will reprice if interest rates go up. So when we look at bonds, we try and keep the term under 5 years. Another vehicle that we think is attractive in these markets are high-yield bonds. Again, they pay a high coupon. They tend to have terms of 4 years or less. And that high coupon with a credit spread in a high-yield bond, if the economy starts improving, that credit spread will narrow and you'll get some nice capital gains. It's the same in mortgages. Pay a nice risk-adjusted return, relatively short term. Global bonds, not every country is like the U.S. that's paying a low coupon and has a bad balance sheet. There are a lot of emerging market nations that have very nice coupons and their fiscal position is extremely attractive. You want global bonds in your portfolio. They are a good diversification. And finally, hedge funds and gold. Hedge funds provide you a low correlated or a non-correlated return versus stocks and especially bonds that give you some good diversification of portfolio. And gold is always perceived to be a good hedge against inflation, but the biggest thing about gold when it does the best is when interest rates are negative. And that's the situation we have right now. We like gold as like an insurance policy in clients' portfolios. Now, hopefully, tonight I've given you enough of an impression that we think the path should be to the brighter side, to the left. And in summary, we think the reason for that is we think that deleveraging cycle in the U.S. is going quicker than we thought it would on the consumer side. We're still worried about the government side. In Canada, it's exactly the opposite, and that's a concern for growth in Canada. Economic growth in the U.S., we're not expecting to see very strong growth. It's going to be slow, but progressing, and we are more optimistic than we were last year. And the reason is because we're seeing signs of strength in the employment market and the housing market in the U.S. Canada, not so much. The good thing about Canada is the U.S. If the U.S. does better, Canada should also do better. Now, the three threats we talked about, they're still there. We are hoping that you won't see as big an impact from Europe because, quite frankly, Europe is what drove the market, the volatility that we saw in the second half of last year. Hopefully, with yields in Spain and Italy moving down, we should see some of the results in the economy come through in the market returns. But those threats are still there, and that's why it's very important to look at diversification and cash flow in your investment portfolios. So with that, I'm going to turn it over to John.